This makes no sense. Silver dropped 4.4% while war escalated in the Middle East. Bombs are falling, missiles are flying, geopolitical uncertainty is spiking, and the historical safe haven asset crashed instead of soaring. If you're confused, you should be. If you think this was natural market behavior, you've been deceived. If you believe supply and demand drove this move, I'm about to shatter that illusion. Welcome to the Market Cipher. I'm here to decode what just happened, why it happened, and what the COMEX data says comes next within 72 hours. Let me be crystal clear from the start. Silver didn't drop because of the Iran war escalation. Silver dropped despite the Iran war escalation. And the weapon used to engineer this counterintuitive move has a name, the dollar. More specifically, the deliberate weaponization of dollar strength at precisely the moment when silver should have exploded higher. This was not coincidence. This was coordination. And the fingerprints are all over the COMEX data. Let me walk you through exactly what happened in the last 48 hours. Iran launched its most significant military strike in months. Regional tensions spiked to levels not seen since the initial October escalation. Oil prices jumped, defense stocks soared, flight paths were rerouted. The world held its breath. In any rational market, precious metals should have caught a massive safe haven bid. Gold and silver have served as crisis hedges for thousands of years. When bombs fall, smart money historically flows into hard assets. But silver dropped 4.4% in a single session, while war escalated. This inversion of historical patterns reveals the manipulation mechanism more clearly than any chart analysis ever could. They showed their hand. They revealed the playbook. And I'm going to break it down piece by piece. The weapon was the dollar index. Within hours of the Iran escalation, the DXY spiked aggressively. This wasn't organic flight to safety. This was coordinated intervention designed to suppress precious metals at precisely the moment they should have risen. Think about the logic they want you to accept. War breaks out. Uncertainty spikes. And investors supposedly flee to the US dollar, the currency of a nation $35 trillion in debt, running trillion-dollar annual deficits, with a central bank that has printed more money in 5 years than in its entire previous history. That's the safe haven? That's where scared money runs? The narrative collapses under the slightest scrutiny. But the price action doesn't need to make sense. It just needs to achieve the objective. And the objective was preventing silver from breaking out during a geopolitical crisis. Now let me show you the COMEX data that reveals what's really happening beneath the surface. The Commitment of Traders report released just before this move showed commercial traders, the big banks, holding near-record short positions in silver futures. They were maximally exposed to rising prices. A war-driven spike would have cost them billions. They needed silver to drop. The war gave them the perfect cover story. They engineered a dollar spike, blamed safe haven flows, and crashed the metal that should have benefited most from geopolitical uncertainty. But here's what the COMEX data reveals that they don't want you to see. Despite the 4.4% price crash, delivery demands haven't decreased. Standing notices remain elevated. The entities who actually want physical silver aren't selling, they're holding. They're waiting. The paper price crashed. The physical market didn't blink. This divergence is critical. It tells you the crash was manufactured in the paper market through derivative manipulation, not driven by actual selling of physical metal. Real silver didn't change hands at these lower prices. Paper contracts were shuffled to create the illusion of selling pressure. Now let me explain the dollar mechanism in detail, because understanding this is essential to seeing through the manipulation. Silver is priced in dollars globally. When the dollar strengthens, silver becomes more expensive for foreign buyers. This theoretically reduces demand and pressures prices lower. The relationship is real, but typically modest. What we witnessed wasn't a modest dollar adjustment. It was an aggressive, coordinated dollar spike precisely timed to coincide with an event that should have been bullish for precious metals. The magnitude and timing reveal intervention, not organic capital flows. The Federal Reserve and Treasury have tools to influence dollar strength. Currency swap lines, interest rate expectations, coordinated statements with allied central banks, direct intervention in currency markets. When they need a stronger dollar to suppress commodity prices, they can engineer one, and they did. Right as Iran escalated, right as silver threatened to break out, right as the banks needed protection for their short positions. The probability of this timing being coincidental is essentially zero. Now let me show you what the COMEX warehouse data reveals about the next 72 hours. Registered silver inventory continues hovering near historic lows. We're talking about roughly 90 million ounces available for delivery against hundreds of millions in paper obligations. The coverage ratio remains dangerously thin. Delivery notices for the active month show no signs of declining despite the price crash. Sophisticated players aren't fooled by paper manipulation. They're using the lower prices to accumulate more metal at cheaper levels. The warehouse data shows metal leaving, not entering. Despite the price drop, silver isn't flowing into COMEX vaults. It's flowing out. This tells you the crash was paper-driven, not fundamentally driven. In 72 hours, we'll have updated delivery data. Based on current patterns, I expect standing delivery demands to actually increase. Why? Because smart money views this crash as a gift. They're taking delivery at artificially suppressed prices. The data will show the divergence clearly. Paper prices crashed. Physical demand remained. The manipulation created a buying opportunity for those who understand the game. Now, let me explain why war escalation is actually bullish for silver, despite what just happened. War consumes silver. Military electronics, guidance systems, communications equipment, missiles, and defense infrastructure all require significant silver inputs. The more conflict escalates, the more silver gets consumed. War disrupts supply chains. Silver mining operations in unstable regions face operational challenges. Refining and transportation networks get stressed. Supply becomes less certain precisely when demand increases. War undermines confidence in financial assets. Stocks become risky. Bonds from indebted nations become questionable. Currencies backed by nothing become suspect. Hard assets with intrinsic value become attractive. Every historical principle says silver should rise during war escalation. The 4.4% drop violates centuries of market behavior. This violation isn't evidence that silver is broken. It's evidence that silver is manipulated. The manipulation can suppress prices temporarily. It cannot suppress them permanently. The fundamentals eventually overwhelm the intervention. And the fundamentals just got more bullish with war escalation. Now let me discuss the dollar trap that's being set. The dollar spike that crashed silver creates its own vulnerabilities. A stronger dollar makes American exports less competitive. It pressures emerging market debtors who borrowed in dollars. It creates deflationary pressure that the Fed supposedly wants to avoid. The very strength engineered to crush silver becomes economically problematic if sustained. The Fed cannot maintain aggressive dollar strength without consequences for growth, employment, and financial stability. This means the dollar spike is temporary by necessity. They can engineer strength for specific interventions. They cannot maintain strength without crashing the economy. The dollar will retreat, and when it retreats, silver explodes higher. The 72-hour window matters because currency interventions typically cannot be sustained beyond short bursts. The economic forces that pressure the dollar lower, the debt, the deficits, the money printing, reassert themselves quickly. Watch the dollar index over the next 3 days. If it retreats from current levels, silver will recover aggressively. The 4.4% drop will be erased. The manipulation will fail, and we'll be back to testing breakout levels. Now let me explain what the options market reveals about expectations. Despite the 4.4% crash, options activity shows heavy call buying at higher strikes. Traders are betting on higher prices despite the immediate drop. They're looking through the manipulation to the fundamental reality. Put volume increased, but not proportionally to the crash magnitude. If this were genuine bearish sentiment, put buying would have spiked dramatically. Instead, we see call accumulation at depressed prices. The smart money in options is using this crash to position for higher prices. They recognize the manipulation. They're exploiting it rather than being victimized by it. Open interest data shows longs holding through the crash. The liquidation cascade the manipulators wanted hasn't fully materialized. Traders learned from previous manipulation events. They're maintaining positions through the volatility. This resilience frustrates the manipulation objective. They crashed prices 4.4%, but didn't trigger the mass liquidations they needed. The short-term pain didn't translate to capitulation. Now let me discuss what history says about war-driven silver suppression. We've seen this pattern before. During the initial Gulf War, silver was suppressed even as geopolitical uncertainty spiked. The suppression lasted weeks before fundamentals overwhelmed intervention. During the 2003 Iraq invasion, similar suppression occurred. Silver was held down through the initial conflict phases. Once the intervention capacity was exhausted, prices resumed their upward trajectory. The pattern repeats because the playbook doesn't change. Use crisis moments to suppress rather than allow safe haven buying. Exhaust intervention capacity during the crisis, then lose control when capacity runs dry. Each cycle follows the same arc. Suppress during crisis. Exhaust resources, lose control, watch prices explode higher. We're in the suppression phase now. The 72-hour window likely represents peak intervention capacity. Then fundamentals reassert themselves. Then silver recovers and exceeds previous highs. Now let me explain the psychological warfare component. Crashing silver during war escalation serves a propaganda purpose beyond immediate price suppression. It undermines confidence in silver as a safe haven. It makes stackers question their thesis. It creates doubt about the fundamental case. This psychological damage is intentional. If they can make you believe silver doesn't respond to crisis, maybe you'll sell. Maybe you'll stop accumulating. Maybe you'll move to assets they can control more easily. Don't fall for it. The 4.4% drop during war escalation proves manipulation, not fundamental weakness. It proves they needed to intervene precisely because silver should have risen. It proves the thesis is correct, not wrong. A manipulated market is not a broken market. It's a market with artificial distortions that eventually correct. Those corrections tend to be violent and sudden when they occur. The psychological operation wants you demoralized. Stay rational instead. Look at the COMEX data. Look at the inventory levels. Look at the supply deficit. Look at the delivery demands. Everything fundamental says silver should be higher. The only thing saying otherwise is a manipulated paper price. Now let me give you the specific indicators to watch over the next 72 hours. First, monitor the dollar index hourly. If DXY rolls over from current elevated levels, silver will recover rapidly. Currency interventions rarely sustain beyond 48-72 hours without massive ongoing commitment. Second, watch COMEX delivery notices. Updated data releases within this window. If standing delivery demands increase despite lower prices, it confirms smart money is buying the dip rather than selling the crash. Third, observe physical dealer premiums. If premiums hold firm or increase while spot drops, the physical market is rejecting paper price discovery. This divergence signals manipulation approaching its limits. Fourth, track registered inventory changes. Any acceleration in vault drainage despite lower prices proves fundamental demand remains unaffected by paper manipulation. Metal leaving vaults during price drops is extremely bullish. Fifth, monitor options market activity. Continued call accumulation at lower prices signals sophisticated traders expect reversal. Put accumulation would signal genuine bearish sentiment. These 5 indicators will tell you within 72 hours whether the manipulation is breaking down or has more capacity remaining. Now let me explain the geopolitical dimension you're not hearing about. The Iran escalation threatens oil supply chains. Oil priced in dollars creates dollar demand. More expensive oil means more dollars needed globally. This provides temporary dollar strength. But oil price spikes are inflationary. Inflation erodes dollar purchasing power. The very crisis creating short-term dollar strength creates medium-term dollar weakness. This contradiction resolves over weeks, not days. The initial dollar spike fades as inflation expectations adjust. Silver then benefits both from safe haven demand and from inflation hedging. The manipulators are exploiting a temporary window. The window closes as the full implications of war-driven inflation become apparent. Smart money is positioning for that transition while paper prices are suppressed. Additionally, war creates supply chain disruptions that specifically impact silver. Refining capacity gets stressed, transportation routes become uncertain. Mining operations in affected regions face challenges. These supply pressures haven't manifested in price yet because paper manipulation is overwhelming physical signals. But physical reality eventually dominates, and physical reality just got more bullish. Now let me address what COMEX data shows about commercial positioning. The banks remain massively short silver futures. Their net short position represents potential losses in the billions if silver rises significantly. They have existential motivation to prevent breakouts, but short positions must eventually be covered. Every contract sold short must eventually be bought back. The only questions are timing and price. If they cover at higher prices, they lose money. If they can engineer crashes to cover at lower prices, they profit. This creates the manipulation incentive. The 4.4% crash provided covering opportunities. COMEX data will show whether commercials reduced short positions during the drop. If they did, they used the Iran crisis as cover for position management. This is the game. Create crisis, engineer crash, cover shorts, reload positions, wait for next opportunity. Understanding the game lets you position ahead of it rather than being victimized by it. Now let me explain what happens when manipulation fails. Every manipulation scheme has capacity limits. Dollar intervention requires coordination across institutions. Short position maintenance requires margin capacity. Price suppression requires willing sellers. When any of these elements exhausts, manipulation fails. And when manipulation fails against a backdrop of genuine physical shortage, the reversal is violent. We saw this in 2020 when paper prices crashed while physical premiums exploded. We saw this in 1980 when suppression collapsed into a parabolic blow-off top. We saw this in 2011 when silver nearly touched $50 before emergency intervention. The current setup has more fundamental support than any previous cycle. Industrial demand is higher, supply deficits are larger, inventory levels are lower. The dollar's long-term weakness is more pronounced. When this manipulation fails, and it will fail, the reversal won't be 4.4%. It will be 40% or more. The compressed spring will release with stored energy from years of suppression. Position for that release, not for the temporary suppression. Now let me give you the actionable framework for the next 72 hours. If you hold physical silver, hold it. The price drop is paper manipulation, not fundamental deterioration. Your metal is still your metal. It still has no counterparty risk. It still represents real value. If you hold paper positions with adequate margin, maintain them. The manipulation will exhaust. The recovery will come. Don't let them shake you out at artificially suppressed prices. If you have dry powder, consider deploying it. War-driven manipulation creates buying opportunities. Prices 4.4% lower, while fundamentals remain unchanged or improved, is a gift from the manipulators. If you were considering selling, reconsider. This is precisely the wrong moment to exit. Selling into manipulation is doing exactly what they want. Hold through the volatility. If you're new to silver, study this moment carefully. This is how manipulation works. This is how they shake out weak hands. Understanding this prepares you for future cycles. The next 72 hours will reveal whether manipulation has exhausted or has remaining capacity. Either way, the long-term trajectory remains up. Let me close with what the manipulators don't want you to understand. Silver dropped 4.4% as Iran war escalated. This should be impossible under normal market conditions. The fact that it happened proves intervention, not fundamental weakness. The dollar was the weapon. It was spiked precisely when silver should have soared. The timing reveals coordination. The magnitude reveals desperation. COMEX data shows physical demand unaffected by paper prices. Delivery notices remain elevated. Inventory continues draining. The divergence between paper and physical grows wider with each manipulation event. Within 72 hours, we'll have updated data confirming whether smart money bought this dip. History suggests they did. History suggests the manipulation will fail. History suggests silver will recover and exceed previous levels. The war is actually bullish for silver despite the crash. Supply disruptions, industrial consumption, inflation pressures, and safe haven demand all support higher prices. The manipulation can delay this reality. It cannot prevent it. The cipher is clear. The dollar did this. The war was the excuse. The banks needed cover. The manipulation revealed their desperation. This is the market cipher. Silver dropped 4.4% as bombs fell. The dollar spiked to suppress the safe haven bid. COMEX data shows physical demand holding firm. Within 72 hours, we'll know if the manipulation has broken. Watch the indicators I described. Position for the reversal. Don't let them shake your conviction. They crashed silver during a war. Think about how desperate that is. Think about what that reveals about their position. Think about what happens when they lose control. Like and subscribe if you want to see the COMEX data analysis when it updates in 72 hours. Share this video with anyone confused by silver dropping during war escalation. Help them understand manipulation, not fundamentals, drove this move. The war escalates. The dollar spiked. Silver dropped. And none of it changes the fundamental reality. There isn't enough physical silver to meet demand. That reality will assert itself. Position accordingly before it does.